The Fed just held rates again. And if you're carrying high rate debt right now, that's not just inconvenient, that's a financial emergency hiding in plain sight. We're talking credit cards charging 22, 23, even 29% APR while your money quietly bleeds out every single month. Let's set the scene. The Federal Reserve has kept benchmark rates elevated heading into 2026, meaning every dollar you owe on a variable rate card or personal loan is costing you more than it should and more than it will eventually. The cruel irony is that the same institution designed to stabilize the economy is, right now, the reason your minimum payment barely touches your principal. So how do we get here? Think of interest rates like a thermostat. The Fed cranks up to cool down an overheated economy. The problem is, when inflation runs hot, they turn that dial way up and consumers get scorched while waiting for the room to cool down. It's macroeconomic medicine that tastes absolutely terrible if you're the one swallowing it. And here's where the whiplash really sets in. Just a few years ago, rates were near zero, credit was basically free money, and everyone was refinancing everything with a smile on their face. Now that same home equity line, that same personal loan, that same balance you meant to pay off is charging you like a luxury hotel minibar, aggressively and without apology. The psychological toll of this is real and it's sneaky, because high rate debt doesn't just drain your wallet, it quietly erodes your confidence, your decision making, and your willingness to even look at your statements. Experts like behavioral economist Richard Thaler have long argued that financial stress narrows our thinking, and when we're overwhelmed, we default to inaction, which, with compound interest, is literally the worst possible move. Debt cycles, like this one, aren't new. We saw elevated borrowing costs punish consumers in the early 1980s when the Fed funds rate hit nearly 20%. And people who survived that era will tell you the ones who made it through had a plan, not just prayers. History doesn't repeat exactly, but it rhymes loudly enough that we should absolutely be taking notes. Here's the thing though, high rate debt follows a predictable pattern within a larger economic cycle. And the window between rates are high and rates come down is exactly when disciplined action creates the biggest long-term advantage. Step one is brutally simple. Identify every debt above 8% APR and rank them from highest rate to lowest. That list is your enemy roster, and you need to know exactly who you're fighting. Now, the two heavy hitter repayment strategies you need to know are the avalanche method, attacking the highest rate debt first to minimize total interest, and the snowball method, which targets the smallest balance first for psychological momentum. Neither is wrong. The right one is whichever one you'll actually stick to, because consistency beats perfection every single time. One misconception we need to obliterate right now is that balance transfers or debt consolidation are just kicking the can down the road. No. Done correctly, moving a 24% APR balance to a 0% promotional card for 12 to 18 months is you literally buying time with math. Just make sure you read the terms, have a payoff plan, and don't use the freed up card as an invitation to spend again. The next move is tightening your budget, not forever, just strategically. And this is where people get emotional instead of analytical. Every subscription you pause, every dinner you cook instead of order, every nice to have you delay is a direct payment toward getting out from under the interest rate thumb of the Federal Reserve. Set up automatic payments, minimum at the very least, more whenever possible, because a single late payment can spike your APR even higher, tank your credit score, and close the door on better loan terms when rates eventually do fall. Think of autopay less like a convenience and more like a financial seatbelt. You put it on, not because you expect to crash, but because the cost of not wearing it is catastrophic. The deeper lesson here, and one that every market cycle teaches us eventually, is that the investors and consumers who come out ahead aren't the ones who timed the rate cut perfectly. They're the ones who stayed disciplined, sized their risk appropriately, and didn't let emotion drive the strategy. Conviction without process is just gambling with a confident face. So philosophically, here's where we land. The Fed will cut rates again. They always do eventually. And when that moment comes, the people who manage their debt aggressively during the high rate period will be first in line to refinance, invest, and build. The ones who waited and hoped will still be underwater, just at a slightly lower rate. Be honest with yourself about where you stand. Build your plan around process, not prediction. And remember that the size of your monthly action matters infinitely more than the size of your annual conviction. Comfort doesn't come from knowing when the Fed moves. It comes from knowing that whatever they do, you've already done your part. And when you're ready to take that next step, whether it's real estate investing, home contracting work, or connecting with the right lenders to put your financial foundation to work, check out our links in the description below, and let's get you started.